people like I think it was Redfin and some other like Morgan Stanley or somebody was saying that they also predict that there's a possibility that the market home prices could go down.
Yeah.
My question is, why are they saying that? Like, what is their prediction for why it would go down? Because for me, I just see interest rates are going to come down, and I think home prices are coming up.
Yeah. So right now, we are personally betting, and betting our own money that interest rates will come down, supply will stay low, and that the market will appreciate. But there's massive factors that can affect this. So let's go. Why did the Fed raise interest rates to begin with?
Because of inflation.
Because of inflation.
Yeah, because they kept them so low and cheap money, and they had to go vacuum it up, basically.
100%. So if inflation reared its ugly head, could the Fed potentially raise rates again? Yes or yes?
Yeah.
Perfect.
Or just say we're not lowering them like we said we were going to.
Exactly.
Yeah.
So that could adversely affect home prices.
Okay.
Rises in unemployment. So the unemployment rate right now is rising. You can see the Fed doing that, and you can see the Fed talking about where they believe it's going to end up by the end of 2024. I believe the prediction was like 4.7 or somewhere right around there as the unemployment rate. But if unemployment jumps and all of a sudden we're in the 5s or the 6s, our whole economy is based on consumerism. If that consumer breaks, then what happens is, I can't pay my credit cards, my car payments, things like that. Well, does that then turn around and affect rents and housing prices? Yeah, 100%.
Absolutely.
It's a domino, okay? So a massive rise in inventory could also cause this. Well, what would cause rises in inventory?
Lack of affordability.
Lack of affordability is one. Foreclosures. Okay, so let's go back to that consumer. That consumer breaks. They can't afford it. Unemployment's high. So all of a sudden we have a rise in bankruptcies, a rise in foreclosures. Foreclosures at an all-time low right now. And foreclosures peaked out at 4% during the Great Recession. And right now we're at 0.4.
Yeah, I heard a number of people talking about if were to be someone who couldn't afford their home that they had bought when interest rates were low, more than likely they have a bunch of equity in it. And it would just show up as inventory, as normal inventory, rather than a foreclosure. Because they could just throw it on the market because they probably have enough skin there to get out.
100%. I 9,000% agree with you. We most likely won't see a rise in foreclosures because most of the U.S. has created so much equity over the last few years. But we're talking about what would cause prices to go down. So if that consumer just gets really beat up, unemployment really rises, that could cause inventory to rise. And it starts with the consumer. Consumer confidence actually went up according to the consumer confidence survey that just came out yesterday. Went up just a little bit. But if consumer confidence gets too low and the psyche of the consumer is beat up because unemployment, because wars, because inflation, natural disaster, if that consumer really stops spending, the whole U.S. economy breaks. Also, lending standards have gotten tighter. So if lending standards stay the same or for some reason increase, we know that in March, the bank bailout program is ending. So the Federal Reserve turned on the money printer after Silicon Valley Bank and the other problems that popped up, Signature Bank, those. And they said, hey, you can bring us our assets. We'll give you face value for them and we'll hand you cash so you can prop yourself up. That goes away in March.
So basically they need to get their crap together before then.
Bingo. That goes away. It goes away mid-March. So if by mid-March banks aren't ready, that could, and of course Congress can extend this. Let's assume they don't. Well, if bank liquidity dries up and their balance sheets aren't clean enough, then lending standards have to increase. If lending standards increase and it's harder for buyers and investors to qualify, that could hurt home prices. Overbuilding technically did happen in 2004. 4, 5, and 6. And it is one of the things that led to the Great Recession was we overbuilt in that new construction space. I don't see this happening, but if for some reason, let's just say
in our local market,
not in our local market, but in most markets. Okay. So in our local market, it's never happening. We're too liberal.
Yeah.
We'd have to massively decrease regulation. But the same thing would also have to happen across the country. You'd have to see a massive decrease in regulation and you'd have to see massive funding go to the builder side and that relax. Here's one that also hurts. So what's going to happen in 2024, like politically?
An election.
We've got the presidential election coming up. Do you like all those negative ads that get run, though?
No. All the campaigns and all like that type of stuff you're talking about? Yeah, no.
As the election nears, what traditionally happens to real estate is the real estate market slows down, and you can see like a 10% drop in total like unit count sales. That's not prices, in just sales, because of fear, because those election ads start running.
Why is that? Like, I always hear, at least from the time that I've been in real estate for this number of years, is that people are always like, oh, it's an election year. I'm like, what does that mean?
It's the FUD.
Because I've literally never seen it affect the real estate market.
It may not affect you. There's a difference between a professional like you, and there's a difference between the average agent in the market. So I love that it doesn't affect you, but from just like a raw statistics perspective, the market slows down. Well, why does it slow down?
Fear in the market.
Just the fear.
Because people hear, it's an election year, I got to be careful.
And they get overly worried about what one man or what one woman may do as the president. And they believe that individual can affect things more quickly than they can. Other things that could hurt us. Speculative bubbles. Go back and look at crypto. As crypto mooned, everyone's a moon boy. They're like,
diamond hands.
Yeah, diamond hands to the moon. Let's go. And they're just betting and betting and betting. When that bubble popped, it hurt a lot of people. So speculative bubbles in any asset class, crypto, gold, real estate, as they pop, they can affect home prices.
Yeah.
Next, recessions. A mistake people make because of the Great Recession is we make the assumption that all recessions are like that and housing will behave the same.
Probably because that's just the biggest one that most people who are alive have been through.
Bingo.
I mean, there's like all these tiny ones that maybe in your industry you didn't even feel, but that was the one that probably the most people were tied to.
And the most people got hurt that are still alive.
Yes.
So our mind, we avoid pain, we go towards pleasure, and we go, man, that was painful. Even if you didn't own real estate, you may remember what your parents did, or maybe you lost some real estate during that. So what happens is we assume because of the Great Recession that home prices always go down. And the reality is home prices don't always go down. Statistically, they actually are flat or they go up more than they go down in a recession.
And really, if I'm not mistaken, that crash happened because of the housing market and what was happening in the housing market. So it was the catalyst that did that.
Yes.
So that's what really ultimately was affected the most.
That was our first housing-based recession caused by housing.
It's actually crazy if you haven't looked into it. I mean, obviously we're in the industry, so we know about it, but just knowing what kind of regulation there is now with getting a loan. I mean, it seems pretty standard. It's like, how much money do you make? Okay. Well, let me check on that. Before, they're just like, how much money do you make? You're like, $100,000. And they're like, sounds good.
Yeah. So maybe you should have to prove how much money you make.
Yeah, it's pretty wild. I mean, when you look back on it, you're like, no, like, how did no one see that coming? Like, that's insane. If you knew anything about the lending restrictions, they just didn't even do any due diligence.
Next on the list, government policies.
Yep.
Government policies can vastly affect the value of real estate. Let's give an example because we like land development. We like investing. You can have a tract of land and its zoning could be residential, and government policy comes through and boom, all of a sudden it's high density, multifamily, or commercial. Well, the value of that land or that house may have just doubled or tripled overnight. The same works in reverse. Government can come in and they can pass a law, pass a regulation, and all of a sudden massively devalue real estate. We also can't discount natural disasters. Natural disasters are on the rise. Texas had those massive power outages because of all the freezing rain.
Yeah.
Okay. We've seen more hurricanes, hitting Florida and the coast.
Tennessee just got hit not too long ago.
Yeah. Well, wasn't that like a big tornado or something?
Yeah.
So you've got these things that are happening and that can vastly affect real estate prices. So one of the things that people don't think about is like when you're in a multifamily situation and you own a building or just commercial real estate in general, the value of commercial real estate is based on its net operating income. Yep. The actual market value is based on the net operating income of the asset.
Got it.
So as insurance and taxes, and we've seen property taxes do the same thing. So as insurance and taxes go up, the net operating operating income goes down and the value of that asset goes down. And I read this in the CPI numbers. There was one point this year where insurance was up like 26% across the board. Well, if you take your expenses for a commercial building, let's say it's multifamily, and all of a sudden the expenses are up 10, 15%, that could drop the value of that asset by millions of dollars because it's so expensive now to operate. And we know that rents have been kind of flat. So let's land the plane, finish this one out. Global economic factors. So because our economy is tied globally, as wars happen, as conflicts happen, as supply chains fall apart, as trade tensions build, as geopolitical issues pop up, as foreign investment in real estate changes, okay, that all can affect home prices.